Gold is often spoken about as if it were a single thing, a price on a screen, a hedge, a fear trade. But in reality, gold exposure comes in layers, and one of the most important layers is not the metal itself, but the quality of the ground it comes from and the discipline of the company pulling it out. Today's episode is about one of those companies that quietly sits in the middle ground between speculation and certainty. Not a global major, not a promotional explorer living on drill results, but also not a bloated producer struggling under its own weight. This is a company that has spent years rebuilding a single asset with a very specific idea in mind, that fewer ounces, if they are high enough quality, can matter more than scale. Bellevue Gold Ltd is an ASX-listed gold miner operating in Western Australia, a jurisdiction that has become almost boring in its reliability. That is not a criticism. In mining, boring is often exactly what investors want. Stable law, established infrastructure, a skilled workforce, and above all, geology that has been understood, exploited, abandoned, and then rediscovered with better tools. The Bellevue gold mine itself is not new. What is new is the way it is being approached. Historically, this was one of the highest grade gold mines in the country. Then it went quiet. Not because the gold disappeared, but because economics, ownership, and timing moved on. Bellevue Gold's story is the story of returning to an old system with modern eyes and modern discipline. This matters because we are no longer in an era where volume alone wins. Costs are rising, energy is expensive, labor is tight, capital is selective. In that environment, grade becomes leverage. Not financial leverage, but geological leverage. The kind that allows a company to move less rock, process less material, and still generate meaningful margins. What makes Bellevue interesting is not just that it is producing gold, but how it is producing it. Underground, selectively, from narrow, high-grade veins that reward precision rather than brute force. This places the company in a very different category from the large, low-grade, open-pit operators that dominate global gold indices. But quality cuts both ways. High-grade underground mining demands execution. It leaves less room for error. Development delays, cost overruns, or geological surprises are felt more quickly. Bellevue's market perception, therefore, rests on a single question. Can management consistently convert geological quality into operational reality? That question sits at the heart of today's SWOT analysis. In the sections that follow, we will break Bellevue Gold down methodically. We will start with its strengths, because this is where the investment case is clearest and most tangible. Then we will move through the weaknesses that come with underground concentration. From there, we will look at the opportunities that extend beyond simple production. And finally, the threats that could undermine even a high-quality asset if conditions shift. This is not a hype piece. It is not a warning either. It is an attempt to understand where Bellevue Gold truly sits on the risk spectrum of ASX gold miners, and whether its reputation for quality is deserved, sustainable, and investable. Let's begin. Strengths. The primary strength of Bellevue Gold is not scale, geography, or marketing. It is grade, and more specifically, consistent high grade in a stable jurisdiction. Everything else in the investment case flows outward from that single fact. Bellevue is built around an underground ore body that sits well above the global average for gold grade. In an industry where many producers are now scraping along at 2 grams per ton or less, Bellevue's system regularly reports grades that would have been considered exceptional in almost any era of mining. This matters because grade is the most powerful lever in mining economics. Higher grade means less rock moved, lower energy use per ounce, reduced processing intensity, and a structurally lower cost base when operations are well run. That geological advantage feeds directly into margins. Bellevue does not need a high gold price to survive. It benefits from one, certainly, but it is not hostage to it in the way lower-grade operators are. This gives the company a degree of resilience that is increasingly rare, particularly in an inflationary environment where labor, diesel, reagents, and contractor costs have all moved sharply higher. Another core strength is asset focus. Bellevue Gold is not trying to be everything at once. It is a single asset company by design, not by accident. That concentration brings risk, which we will come to later, but it also brings clarity. Management attention is not diluted across multiple jurisdictions or development pipelines. Capital allocation decisions are simpler. Operational learning compounds faster. Mistakes are harder to hide, but successes are easier to repeat. The location of the Bellevue Gold Mine in Western Australia is also a quiet but significant strength. WA remains one of the most reliable mining jurisdictions globally. Permitting risk is low, rule of law is strong. Infrastructure, power access, skilled labor pools, and contractor ecosystems already exist. For investors, this reduces the number of unknowns that need to be priced into the valuation. You are betting on execution and geology, not on politics. Bellevue's redevelopment pathway also deserves credit. Transitioning from explorer to developer to producer is where many ASX mining stories break down. Bellevue spent years de-risking the asset before committing to full production, focusing on resource definition, mine design, and infrastructure planning, rather than rushing to market on optimism alone. That slower, more deliberate approach has helped establish credibility with institutional investors who have seen too many juniors promise production and deliver dilution instead. There is also a strategic strength in the underground mining model Bellevue has chosen. While underground operations are technically more demanding, they are often better suited to high-grade, long-life systems like Bellevue's. They allow for selective mining, tighter control of dilution, and the ability to chase grade continuity at depth. Importantly, underground mines can often extend life incrementally through drilling rather than relying on large, capital-intensive expansions. Finally, Bellevue benefits from timing. Gold remains a monetary metal in a world of fiscal strain, rising debt, and fragile confidence in fiat systems. Investors are increasingly selective about how they gain exposure. The market is shifting away from marginal ounces and toward quality ones. Bellevue sits directly in that path, offering exposure to gold through a company that is defined more by geological quality than by scale-driven ambition. Taken together, these strengths position Bellevue Gold as something closer to a quality compounder than a speculative trade. That does not make it risk-free, but it does mean that its upside is rooted in fundamentals rather than hope. Next, we need to address the other side of that coin, because the very features that make Bellevue strong also impose limits and vulnerabilities. Weaknesses. Bellevue Gold's weaknesses are not hidden. They sit in plain sight, and they stem directly from the same choices that underpin its strengths. This is a company that has deliberately concentrated risk in pursuit of quality, and concentration always comes with consequences. The most obvious weakness is single asset exposure. Bellevue lives and dies by one mine, one ore body, and one processing pathway. There is no portfolio diversification to absorb operational shocks. If development slows, grades underperform expectations, or technical issues arise underground, there is nowhere else in the business to compensate. For investors, this means Bellevue is not a gold sector proxy. It is a focused bet on a specific system and a specific execution plan. Underground mining itself introduces a second layer of risk. High-grade underground operations demand precision, dilution control, ground stability, ventilation, and development sequencing all matter far more than they do in large open-pit operations. A small error in stope design or scheduling can materially impact head grades and costs. While Bellevue's geology is strong, underground mining leaves less margin for operational complacency. There is also production ramp-up sensitivity. Companies transitioning into steady-state production are exposed to market scrutiny at exactly the wrong moment. Early quarters are rarely smooth, yet expectations are often priced as if they will be. Any delay in achieving nameplate capacity or any mismatch between guided and realized output can weigh disproportionately on sentiment, even if the long-term picture remains intact. Capital intensity is another structural weakness. Underground development requires sustained capital investment simply to maintain access to ore. Declines, lateral development, ventilation upgrades, and fleet replacement are not optional. They are the price of staying in business. While Bellevue's high grades help offset this, the company does not enjoy the same operational flexibility as a low-cost open pit that can scale up or down more easily in response to market conditions. Bellevue is also exposed to cost inflation, particularly in labor. Western Australia's mining sector remains highly competitive, with skilled underground workers in constant demand. Wages, contractor rates, and staff retention costs can erode margins quickly, even in high-grade operations. Bellevue's economics are robust, but they are not immune. Another weakness lies in market positioning. Bellevue often sits in an uncomfortable valuation middle ground. It is no longer a speculative explorer, but it is not yet a diversified producer with multiple cash-generating assets. That can limit the natural investor base. Some funds will see it as too risky. Others will see it as lacking the scale they require. This can lead to periods where operational performance improves, but share price response lags. Finally, there is geological concentration at depth. While Bellevue's resource has shown impressive continuity, underground mining increasingly relies on drilling to extend life and maintain grade. Success here is never guaranteed. Even in well-understood systems, grade distribution can vary, and unexpected structural complexity can emerge as mining progresses deeper. None of these weaknesses are fatal, but they are real. Bellevue's investment case does not hinge on avoiding them. It hinges on managing them consistently and transparently over time. With the risks clearly framed, we can now look forward, because it is in the opportunities that Bellevue's longer-term trajectory becomes clearer. Opportunities. The opportunity set for Bellevue Gold is less about discovery in the traditional sense and more about compounding quality over time. This is not a company chasing headline-grabbing frontier exploration. Its upside lies in doing a relatively small number of things exceptionally well, repeatedly, and letting the mathematics of grade, margin, and mine life do the heavy lifting. The most immediate opportunity sits underground, quite literally, in resource growth at depth. High-grade gold systems are rarely neat or finite. They tend to persist, narrow, widen, split, and recombine as they extend downward. Bellevue's drilling history has already demonstrated continuity beyond early expectations, and every successful extension effectively lengthens mine life without the need for new surface infrastructure. That is one of the most capital-efficient forms of growth available to any miner. There is also an opportunity in operational optimization. Early production phases are rarely peak performance phases. As the mine matures, development improves, stopping sequences become more predictable, and dilution control tightens. Incremental gains in recovery rates, throughput stability, and scheduling efficiency may not make headlines, but they compound quietly into higher free cash flow over time. Bellevue also has strategic optionality in production flexibility. High-grade underground mines can often choose which areas to prioritize depending on market conditions. In periods of weaker gold prices, operators can focus on the highest margin zones. In stronger price environments, they can afford to bring marginal areas into the plan without damaging overall economics. That optionality is valuable in a volatile macro environment. On the capital markets side, Bellevue has the opportunity to re-rate from developer to established producer. This transition is less about ounces and more about trust. As production history lengthens and guidance proves reliable, the company may begin to attract a broader class of long-term capital. For some institutions, demonstrated operational consistency matters more than upside potential, and Bellevue is still early in building that track record. There is also an acquisition-adjacent opportunity, even if Bellevue never makes a move itself. High-quality, long-life, high-grade assets in safe jurisdictions are increasingly scarce. As larger producers struggle to replace reserves organically, companies like Bellevue naturally appear on strategic radars. That does not mean a takeover is inevitable or even desirable, but it does provide an underlying floor of strategic relevance that many smaller miners lack. Macro conditions amplify these opportunities. Gold is increasingly viewed not just as a commodity, but as a monetary hedge in a world of persistent debt expansion and geopolitical friction. In that context, capital is flowing toward quality exposure rather than speculative volume. Bellevue's profile fits that shift neatly. Taken together, Bellevue's opportunities are not explosive. They are cumulative. If executed well, they point toward a future where the company becomes known less for its transformation story and more for its consistency. But opportunity only matters if it survives external pressure. Threats? The threats facing Bellevue Gold are not abstract or hypothetical. They are the persistent, structural pressures that test every high-quality underground miner over time, regardless of geology or intent. What makes them important is that Bellevue's margin for error, while healthier than many peers, is not unlimited. The most immediate threat is execution risk over time. Underground mines do not fail all at once. They degrade gradually if development, sequencing, or dilution control slips. Even small operational inconsistencies can compound into sustained grade underperformance. Bellevue's valuation assumes that management can maintain discipline year after year, not just through the initial production ramp. Fatigue, turnover, or complacency can quietly erode what was once a strong operational culture. Cost inflation remains a constant external pressure. Western Australia's mining labour market is tight and likely to remain so. Competition for skilled underground workers, engineers and supervisors is intense, and wage escalation is rarely reversible. Energy prices, consumables and contractor availability also remain volatile. While Bellevue's grades provide a buffer, prolonged cost pressure can narrow margins faster than markets often expect. There is also gold price risk, but not in the simplistic sense. Bellevue is not a marginal producer, so a falling gold price does not immediately threaten viability. The real risk lies in investor psychology. If gold enters a prolonged period of stagnation or decline, capital often rotates away from producers regardless of quality. Even well-run miners can see valuations compress as attention shifts elsewhere. Geological risk persists as mining progresses deeper. High-grade systems are attractive precisely because they are complex. Structural changes, faulting, or unexpected variability can emerge with depth, requiring redesigns or altered mine plans. These issues are not failures of exploration, but they can disrupt schedules and increase costs if encountered suddenly. Another threat lies in concentration of narrative. Bellevue's story is well understood by the market, and that clarity can become a double-edged sword. When expectations are tightly defined, there is little room for disappointment. The company must consistently meet or exceed guidance to maintain confidence. Neutral outcomes can sometimes be punished as harshly as negative ones. Finally, there is the broader capital cycle risk. Mining is cyclical, not just in commodity prices, but in funding appetite. Should equity markets tighten, refinancing or expansion capital can become more expensive, even for quality names. Bellevue is not immune to shifts in risk tolerance driven by macroeconomic shocks or financial stress elsewhere in the system. None of these threats are unique to Bellevue Gold. What makes them important is that Bellevue's investment case relies on sustained competence rather than dramatic upside surprises. The company does not promise to outrun these risks. It promises to manage them better than most. That distinction matters. Conclusion: Bellevue Gold does not fit comfortably into the narratives that dominate much of the ASX gold space. It is not an explorer selling possibility, and it is not a sprawling producer selling scale. It sits in a narrower, more disciplined category, one defined by geological quality and the ability to convert that quality into repeatable outcomes. What the SWOT makes clear is that Bellevue's value proposition is fundamentally conservative in nature, even if the market sometimes treats it as a growth story. The company's strengths are rooted in grade, jurisdiction, and focus. Its weaknesses arise from concentration and the technical demands of underground mining. Its opportunities are cumulative rather than explosive, built on extending mine life, refining operations, and gradually earning a re-rating through consistency. Its threats are the ever-present pressures of execution, cost inflation, and shifting market sentiment. Taken together, Bellevue Gold is best understood as a test of discipline. If management executes well, the company does not need heroic assumptions to justify its place in a long-term gold portfolio. It needs time, operational stability, and a gold price that at least remains rational. If execution falters, however, there is little else in the business to mask that failure. For investors, that makes Bellevue neither a safe haven nor a lottery ticket. It is a focused exposure to high-grade Australian gold, with returns driven more by operational competence than by discovery luck or macro drama. In a market increasingly tired of dilution, delays, and under-delivery, that is not an insignificant attribute. Bellevue Gold will not dominate headlines, but if it continues to do what it says it will do, quarter after quarter, it may quietly earn something more valuable than attention: trust. And in mining, trust is often the difference between a company that survives a cycle and one that compounds through it. That, ultimately, is the question Bellevue Gold leaves us with. Not how big it can become, but how well it can continue to execute once the story has stopped being new. That's it for now. Until the next episode, Ta-ta for now.